Hello traders, welcome back to another video. In this episode, I'm going to share how to identify the best order blocks. Walk you through the basic rules of order blocks and the conditions required to identify high-quality ones. If that sounds good, make sure to smash that like button and hit the subscribe button if you haven't already. Alright, let's get started by addressing the basics. So, the big question is, what is an order block? An order block is the last candle that created inefficiency in the market. Yes, it's that simple, don't overthink it. Here's an example. Look at this candle right here. It created an impulse move to the downside, leaving behind a gap. That gap is the inefficiency we're talking about. Now, what do we do with it? We mark the last candle that created that inefficiency as our order block. Those are the basic rules to identify order blocks. Now that we have a clear understanding of how to spot them, let's move on to explore the different types of order blocks. Types of order blocks. Order blocks can show up in two places. At the start of the movement, where the trend kicks off. In the middle of the movement, typically as an opposite-colored candle. Here's an example. So, from this example, we can see the last candle that created the inefficiency. Look at this white candlestick. This is the last candle responsible for the inefficiency, which then left a gap in the market. Can you see that? This candlestick represents the inefficiency created by the last white candle. Therefore, we can mark the white candle as our order block since it's the key point where inefficiency was introduced. Now, observe what happens next. Once the price tapped into the order block, it dropped aggressively to the downside. See how it played out? When we look at the right side of the chart, we can clearly identify a strong downtrend, with the price moving consistently and aggressively lower. Notice this, the price also left another area of inefficiency here. Can you spot it? Here's something crucial to remember. An order block can either be at the start of the movement or sometimes in the middle of the movement. Let's dive deeper into the example on the right. Notice the white candlestick in the middle of the movement. It's an opposite-colored candle. This candlestick also acts as an order block, reinforcing the idea that order blocks can appear in different positions relative to the overall trend. Finally, observe what happens when the price taps into this order block. Once again, the price reacts and moves sharply to the downside. This reaction highlights the importance of identifying order blocks accurately, as they can serve as high-probability zones for significant price movements. 3 major rules for identifying quality order blocks. Let's get into the meat of the presentation, the 3 golden rules for identifying high-quality order blocks. Rule number 1, price must create inefficiency. Inefficiency happens when there's a gap in the market. Picture this, it's like skipping a step while running upstairs, you leave a blank space. In this example, notice the gap between candlesticks. That's inefficiency. Now, compare it with efficiency, where the candlesticks neatly overlap, filling in all the gaps. Think of inefficiency as a treasure map. X marks the spot where the gold is buried. Rule number 2, price must lead to a break of structure or change of character. This is where the magic happens. A break of structure is when price breaks key levels, signaling a continuation of the trend. And then there's the change of character, my favorite. This signals the trend is flipping like a pancake on Sunday morning. Look at this example, we're in an uptrend, price is breaking structures to the upside, but then, boom, a change of character. Price starts moving down, saying, hey, sellers are stepping in. Rule number 3, the order block must be unmitigated. What do we mean by unmitigated? Simple, it hasn't been touched yet. It's fresh, untapped potential. Think of it as the first bite of a hot pizza, you want it fresh, not after someone else nibbled on it. Once price taps into an order block, it's no longer valid. Let's break it down. If price hasn't touched the order block, it's unmitigated. If price has tapped it, it's mitigated, move on. How to trade order blocks. Now that we know what makes a quality order block, how do we trade them? Here's a simple 4-step process. Identify the order block. Mark the last candle that created inefficiency. Place your order at the beginning of the order block. Set your stop loss just above or below the order block to give price some wiggle room. Target a 1-to-2 risk-to-reward ratio. Keep it safe but profitable. Here's an example. Price taps into the order block, triggers our trade, and then, boom, it rockets in our favor. That's the power of following the rules. But wait, what if there's no inefficiency? Don't panic. We've got a tool for that, the Retracement Tool. Here's how it works. Place the tool on your chart. Set your order between the 78.6% and 61.8% retracement levels. Place your stop loss slightly above or below the retracement zone. Why do we do this? To give price enough room to breathe while ensuring a safe entry. Now, let's dive into some of the conditions required to identify high-quality order blocks. Not all order blocks are created equal. Some are high probability, and here's the secret: look for order blocks that are created after taking out liquidity. This setup has played out beautifully. Price took out the liquidity resting below the equal lows, respected the upper order block, and dropped precisely to the downside, just as anticipated. However, it's important to remember that not all setups will play out as perfectly as this one. Markets can be unpredictable, so always manage your risk effectively. When price sweeps liquidity and forms an order block, it's like striking gold. Trend and change of character. In a downtrend, we're selling. In an uptrend, we're buying. Simple, right? But here's the twist: watch for a change of character. A change of character means the tide is turning. The sellers are running out of steam, and the buyers are stepping in, or vice versa. Let's break down this example step by step. Price was initially moving in an uptrend, creating higher highs and higher lows. At some point, the bullish momentum weakened, and price began to shift direction, forming lower highs and lower lows. During this transition, price left behind an inefficiency, a price imbalance that wasn't fully mitigated. This shift also resulted in what we refer to as a change of character, a critical signal indicating a potential reversal from bullish to bearish trends. This change of character is often a strong clue that the market structure is shifting. Next, we look for the last bullish candle that contributed to creating the inefficiency before the move to the downside. We mark this candle as our order block, which serves as a key zone of interest for potential future price reactions. As price retraced, it came back to test this order block, respecting it perfectly. From there, price followed through as expected, respecting the bearish momentum and continuing to move to the downside. This confirmed the trend change from bullish to bearish. This example highlights how understanding market structure, inefficiencies, and order blocks can provide clear setups for trading. Let's dive into one last example to wrap things up. Price is in a clear downtrend, consistently making lower highs and lower lows. After some time, we notice a change of character, a critical signal that the market structure might be shifting and a reversal could be on the horizon. Naturally, we prepare ourselves for a potential buying opportunity. However, upon closer inspection, we see something unusual. There's no inefficiency in this setup. Price moved to the upside with small controlled candles, neatly filling any gaps as it climbed. This means we don't have the typical imbalance to guide us in marking an order block. So, what do? This is where the Fibonacci Retracement Tool comes to the rescue. Acting as dynamic support and resistance levels, this tool gives us a framework for identifying potential entry points even in the absence of inefficiencies. To apply it, we draw the Fibonacci retracement from the swing low to the swing high of the recent move. Now, we focus on a key zone, the area between the 0.618 and 0.786 levels. This golden zone often serves as a prime area for price to reverse or continue in its new direction. We place our buy order within this zone, anticipating that price might pull back into it before resuming its upward push. And just as expected, the market taps into our golden zone, activates our buy order, and begins pushing to the upside with strength. This setup reinforces the importance of adapting to the market's behavior. When there's no inefficiency between the candlesticks, the Fibonacci retracement tool becomes a valuable alternative for finding high-probability entries. Here are common mistakes traders make. Ignoring inefficiency. Trading random candles is like fishing without bait. Chasing mitigated order blocks. If it's been tapped, let it go. It's like eating leftover pizza when there's a fresh one in the oven. Skipping the change of character. Don't trade against the trend unless you see clear signs of reversal. Final thoughts. Order blocks are a powerful tool, but they require discipline. Follow the rules, stay patient, and don't chase the market. Remember, every candle tells a story, and it's up to you to read it. So, go out there, mark those order blocks, and trade like a pro. If you found this helpful, don't forget to like, subscribe, and comment below with your favorite takeaway. Until next time, happy trading.